The American dream of homeownership isn't just fading, it's violently collapsing at a pace that threatens to erase generations of wealth accumulation. What we're witnessing is an unprecedented affordability catastrophe driven by skyrocketing prices and mortgage rates that will make 2008's housing crisis look like a mere market correction. The housing market that once symbolized prosperity and opportunity for average Americans has transformed into an exclusionary system that threatens to destabilize the broader economy. While some analysts remain optimistic about a soft landing, the data paints a far more concerning picture when we examine the underlying fundamentals. The median home price in America reached $402,343 as of August 2024, according to Redfin data. While this represents a modest 1.2% decrease from the previous year, it remains 42% higher than pre-pandemic levels in 2019. This persistence of high prices coupled with elevated mortgage rates has created an affordability crisis that surpasses even the challenges seen during the 2008 housing crash. Mortgage rates have hovered around 6.5% to 7.5% through much of 2024, more than double the sub-3% rates available in 2021. For perspective, a home buyer purchasing a median-priced home with a 30-year fixed mortgage at today's rates will pay approximately $1,000 more per month than they would have for the same home in 2021. This translates to an additional $360,000 over the life of the loan. Housing affordability, measured as the ratio of median home price to median household income, has deteriorated to 5.9 nationwide, well above the historical average of 3.5 to 4 that economists consider suitable. In major metropolitan areas, this ratio often exceeds 8.0, meaning homes cost 8 times the annual household income. Key warning signs that exceed 2008 indicators. Number 1, transaction volume collapse. Existing home sales have plummeted to an annualized rate of 3.84 million units as of July 2024. That's according to the National Association of Realtors. This represents a 35% decline from the pre-pandemic average and the lowest level in 25 years outside of the immediate COVID shutdown period. During the 2008 crisis, transaction volumes bottomed out at about 4.1 million units annually. The dramatic slowdown in market activity reflects a market that is effectively frozen. Potential sellers are reluctant to list their homes and surrender their low mortgage rates, while buyers are sidelined by affordability constraints. 2. The mortgage rate lock-in effect. Approximately 85% of existing mortgages have interest rates below 5%, with nearly 40% below 3.5%. This creates what economists call the lock-in effect, where homeowners are unwilling to sell and take on a new mortgage at significantly higher rates. The resulting inventory shortage has contributed to price stagnation rather than the price corrections needed to restore affordability. This lock-in effect represents an unprecedented structural challenge that wasn't present during the 2008 crisis. The Federal Reserve estimates that this phenomenon has reduced housing mobility by approximately 30%, further constraining an already tight market. 3. Construction sector vulnerability. Housing starts have declined 21.4% year over year as of August 2024, according to the Census Bureau. Builder sentiment, as measured by the NAHB Wells Fargo Housing Market Index, has fallen to 37, well below the neutral 50 threshold that divides positive and negative sentiment. The construction industry employs approximately 7.7 million Americans, and its contribution to the GDP exceeds $1.2 trillion annually. A prolonged downturn could trigger widespread layoffs and business failures, creating ripple effects throughout the economy. 4. Commercial real estate contagion. The commercial real estate sector faces an unprecedented $1.9 trillion wall of maturities between 2024 and 2026, meaning loans totaling this amount will need refinancing. With property values down 15 to 30% from their peaks and interest rates substantially higher, many borrowers will be unable to refinance under acceptable terms. Regional banks hold approximately $2.7 trillion in commercial real estate loans, representing about 67% of all commercial real estate debt. The FDIC has already placed 23 banks on its problem bank list, primarily due to commercial real estate exposure compared to just 9 in 2022. 5. Housing as a financial asset. Institutional investors now own approximately 5% of single-family rental homes nationwide, with concentrations exceeding 12% in certain Sunbelt markets. This represents a significant shift from 2008, when institutional ownership was negligible. The financialization of housing has introduced new systemic risks, as large portfolio owners can amplify market movements through coordinated selling or buying. Additionally, the growth of real estate investment technology has made it easier for smaller investors to enter and exit the market quickly, potentially increasing volatility. The home ownership rate has declined to 65.3% as of Q2 2024, down from the recent peak of 67.9% in 2020 and well below the all-time high of 69.2% reached in 2004. This decline disproportionately affects younger Americans, with the home ownership rate for those under 35 having fallen to just 38.1%. First-time homebuyers now account for only 26% of all purchases, according to the National Association of Realtors, the lowest level since tracking began in 1981. Historically, first-time buyers have represented 38 to 40% of the market. The typical first-time home buyer now needs to save for 9.3 years to accumulate a 20% down payment, compared to 7.5 years in 2019 and 5.2 years in 2012. In high-cost markets like San Francisco and New York, this timeline extends to over 15 years of saving. The housing affordability crisis has exacerbated wealth inequality. Homeowners have benefited from substantial equity gains, with the average homeowner seeing their housing wealth increase by approximately $121,000 since 2020. Meanwhile, renters face an increasingly unaffordable market, with the national median rent having increased 25% since 2019. The Federal Reserve faces an impossible choice: maintaining higher interest rates to fight inflation risks, further damaging the housing market, while lowering rates could reignite inflationary pressures. This policy constraint limits the government's ability to support the housing market, unlike in 2008 when aggressive monetary easing was possible without inflation concerns. Please take 2 seconds to help us out and hit the like and subscribe if you find this video interesting so far. Each like and subscribe helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, let's continue. Housing supply remains constrained by restrictive zoning regulations, high construction costs, and labor shortages. The National Association of Home Builders estimates that regulatory costs add approximately $93,870 to the price of a new single-family home, having increased 132% since 2011. Mortgage debt has reached $12.1 trillion, approximately 17% higher than the peak seen during the 2008 crisis. While lending standards have improved significantly, with subprime mortgages representing just 2% of originations compared to 20% in 2006, the sheer volume of debt creates systemic risks. Non-bank mortgage lenders now originate approximately 68% of all residential mortgages, compared to just 20% in 2007. These institutions face less regulatory oversight than traditional banks and often rely on short-term financing, creating potential liquidity vulnerabilities during market stress. The nationwide rental vacancy rate stands at just 6.3%, near historic lows and well below the 8 to 10% range considered indicative of a healthy market. This shortage has contributed to substantial rent increases, with median rents having risen 25% nationally since 2019. Approximately 49% of renter households are now considered cost-burdened, meaning they spend more than 30% of their income on housing. This represents an increase from 46% in 2019 and approaches the all-time high of 51% recorded in 2011 during the aftermath of the Great Recession. Housing-related spending typically accounts for 15 to 18% of GDP when considering direct residential investment, consumption of housing services, and related spending on furnishings, utilities, and renovations. The current slowdown in housing activity has already subtracted approximately 0.8 percentage points from GDP growth over the past year. Consumer spending patterns show signs of stress, with credit card balances reaching $1.14 trillion in Q2 2024, a 12.6% increase year over year. Delinquency rates on credit cards have risen to 8.2%, approaching levels not seen since 2010. The wealth effect from housing has historically been a significant driver of consumer confidence and spending. Research from the Federal Reserve suggests that homeowners typically spend 5 to 7 cents of every dollar gained in housing wealth. The stagnation or decline in home values could therefore significantly impact consumer spending, which accounts for approximately 70% of economic activity. Looking ahead, potential paths forward. Scenario 1, prolonged stagnation. The most likely scenario involves a prolonged period of market stagnation rather than a dramatic crash. Home prices may decline modestly in nominal terms, 5 to 10%, over the next 2 years, but with inflation running at 2 to 3%, the real inflation-adjusted decline could approach 15%. This would represent a significant loss of housing wealth without triggering widespread defaults. Transaction volumes may remain depressed for several years until the mortgage rate lock-in effect gradually dissipates as homeowners move for non-financial reasons, job changes, family needs, etc. This scenario would create a persistent drag on economic growth, but avoid catastrophic outcomes. Scenario 2, severe correction. A more severe correction could be triggered by several factors. A significant economic recession leading to job losses, forced selling by institutional investors facing redemption pressures, or a commercial real estate crisis that spreads to the banking system. In this scenario, home prices could decline 15 to 25% in nominal terms over 2 years, comparable to the 2008 to 2012 correction. However, improved lending standards would likely prevent the wave of foreclosures seen during the Great Recession. Instead, the primary impact would be felt through wealth effects, construction job losses, and broader economic contraction. Scenario 3, policy intervention. Federal, state, and local governments could implement policies to address the housing affordability crisis. These might include zoning reforms to increase housing supply, tax incentives for first-time home buyers, expanded rental assistance programs, or creative financing solutions like shared equity models. The effectiveness of such interventions would depend on their scale and coordination across different levels of government. Small, piecemeal approaches would likely prove insufficient given the magnitude of the affordability challenges. The current housing market crisis differs significantly from 2008 in its underlying causes, but potentially exceeds in its terms of long-term social and economic consequences. While we are unlikely to see the wave of foreclosures that characterized the Great Recession, the persistent affordability crisis threatens to fundamentally alter the American social contract, with home ownership becoming increasingly unattainable for younger generations. The financialization of housing, combined with inadequate supply and structural barriers to affordability, has transformed a cyclical downturn into a potential secular shift. Without meaningful policy intervention and market adjustments, the housing market may remain dysfunctional for years to come, with profound implications for economic mobility, wealth inequality, and social stability. The data clearly indicates that the current housing market conditions are unsustainable. The question is not whether adjustments will occur, but rather how disruptive that adjustment will be and who will bear its costs. The parallels to 2008 are concerning, not because the specific mechanisms are identical, but because they remind us that housing market dysfunction can have consequences that extend far beyond real estate itself, threatening the stability of our entire economic system. Thank you for watching this analysis, and please make sure you subscribe for continued insights on protecting and growing your wealth during these turbulent economic times. If you found this information valuable, please share this with a friend and watch this one as well.